Have you ever wondered how something as simple as tulips could bring an entire economy to its knees? Welcome to the perplexing universe of market bubbles, a phenomenon as unpredictable as it is devastating. These financial anomalies have the power to inflate economies and then burst them, leaving ruin in their wake. In this journey, we'll explore 5 infamous bubbles, from the tulip frenzy of the 17th century to the more recent Bitcoin bubble. Join us as we delve into the intriguing world of market bubbles, starting with the infamous Tulip Mania. The year was 1637, the place the Netherlands. In the heart of Europe, a frenzy was taking shape, and its object of fascination was not gold or silver, but tulips. Yes, you heard it right, tulips, those beautiful, colorful flowers. It all began in the late 16th century when tulips were introduced to the Dutch from the Ottoman Empire. With their vibrant colors and unique shapes, tulips soon became a status symbol among the Dutch nobility. The demand for these exotic flowers began to surge, and so did their prices. As the tulip's popularity grew, speculators saw an opportunity to make a fortune. They started buying tulip bulbs, not for their aesthetic appeal, but for the promise of reselling them at higher prices. The market for tulips became so inflated that at the peak of the mania, a single tulip bulb could fetch a price equivalent to a luxurious house in Amsterdam. The tulip trade was not regulated, and contracts to buy bulbs at high prices were often made without the buyer having the funds to pay for them. Moreover, these transactions were based on the expectation that the price of tulips would continue to rise indefinitely. However, like all bubbles, Tulip Mania couldn't escape its inevitable burst. In February 1637, the tulip market crashed. Some buyers refused to show up at auctions, while others could not meet their payment obligations. The high prices once commanded by the tulip bulbs plummeted drastically, leaving many Dutch traders in financial ruin. The aftermath of the Tulip Mania left the Dutch economy in shambles. It was a stark reminder of the irrationality of markets and the role of speculation in creating economic bubbles. It also served as a cautionary tale for future generations about the dangers of unregulated trading and the perils of putting all your eggs in one seemingly flourishing basket. Tulip Mania, a floral frenzy that marked the beginning of speculative market bubbles. This historical event serves as a timeless example of how even the most beautiful and benign things can turn perilous when caught in the whirlwind of speculation and market frenzy. Fast forward to 1720, Britain was caught in the grip of the South Sea bubble. The South Sea Company, a chartered joint stock company, had secured an exclusive right over trade in the South Seas. The company's monopoly was not just an economic venture, but a political maneuver aimed at reducing the national debt following the War of Spanish Succession. The South Sea Company promised the moon, or rather the vast wealth that lay across the ocean. Investors were enticed by the allure of untold riches from trade with the Spanish colonies in South America. But here's the rub. The promise was largely a mirage. The South Sea Company's monopoly was based on a peace treaty with Spain that allowed only a single ship to sail each year. Yet the company painted a picture of boundless wealth, and the public bought it hook, line, and sinker. Speculation ran rampant. People from all walks of life, from the nobility to the working class, invested their life savings. Prices of the South Sea Company's shares soared to dizzying heights, peaking in the summer of 1720. But like Icarus flying too close to the sun, the company was destined to fall. The market, built on a shaky foundation of unrealistic expectations and unfulfilled promises, eventually came crashing down. The bubble burst, and with it the fortunes of many. The stock price plummeted, leaving a wake of financial ruin and despair. The fallout was so severe that it led to a wave of investigations and the passing of the Bubble Act, which aimed to curb the formation of such speculative bubbles in the future. The South Sea bubble was not just a financial disaster, but a social one too. It exposed the perils of speculation and greed, and the dangers lurking beneath the surface of seemingly lucrative investments. It served as a stark reminder that when something sounds too good to be true, it probably is. The South Sea bubble, a stark reminder of the perils of speculation and greed. As we move into the 20th century, we encounter the dot-com bubble. This was a time when the world was embracing a new era of technology, marked by the rise of the internet. It was the late 1990s, and internet companies, or dot-coms as they were popularly known, were springing up like mushrooms after a rainstorm. The promise of the internet was irresistible. It was the new frontier, a place where anyone with an idea could start a business and potentially make a fortune. Investors, both professional and amateur, were swept up in the excitement, pouring in capital with the hope of striking it rich. Dot-com startups with no profits, no revenue, and sometimes no viable business model were achieving sky-high valuations. This overvaluation was largely based on speculation and the belief that traditional business metrics didn't apply to this brave new digital world. But as we know, what goes up must come down. The early 2000s saw the bubble burst. The Nasdaq, a stock market index heavily weighted towards technology companies, peaked in March of 2000 and then plummeted, losing nearly 80% of its value over the next 2.5 years. Companies that once had valuations in the billions were suddenly worthless. The fallout was swift and brutal, with many dot-coms going out of business. It's important to note that while the dot-com bubble was a time of excessive speculation and irrational exuberance, it was also a period of incredible technological advancement. It laid the groundwork for the internet as we know it today, and many of the biggest tech companies of our time, including Amazon and Google, survived the crash and went on to become global giants. So, what role did technology and investor excitement play in creating this bubble? Well, it was a potent mix of rapid technological innovation, a lack of understanding about the new digital economy, and the age-old human traits of greed and fear. The dot-com bubble, a digital dream turned nightmare. But it's a story that serves as a stark reminder of the dangers of unchecked speculation and the importance of sustainable business practices. Next on our list is the devastating housing bubble of 2008. A bubble so colossal that its tremors were felt worldwide. The housing bubble was a financial storm that swept over the globe, leaving economic devastation in its wake. Our tale begins with the advent of subprime lending. In simple terms, banks, in their pursuit of profit, started lending money to people who were less likely to pay them back. These were subprime borrowers, individuals with low credit scores and unstable incomes. And what did these subprime borrowers do with the money? They bought houses, of course, lots and lots of houses. Meanwhile, the property market was gleaming with overvaluation. Houses were being sold for far more than they were actually worth. This overvaluation fueled the dreams of homeowners and investors alike, creating a false sense of wealth. Everyone was buying, prices were skyrocketing, and the bubble was inflating. But as we've seen with other bubbles, what goes up must come down, and when it did, it was catastrophic. When the bubble burst, property prices plummeted. Homeowners found themselves deep underwater, with their homes worth far less than they owed. Banks were left with a slew of bad debts, leading to a chain reaction of financial failures. The world was thrown into the Great Recession. Unemployment soared, businesses shuttered, and economies around the globe faltered. The impact was not just financial, it was social and psychological too. Trust in financial institutions dwindled, people's life savings were wiped out, and dreams were shattered. The housing bubble was a stark reminder of the perils of reckless lending and speculation. It demonstrated the domino effect in economics, where one bad decision can lead to a cascade of failures. It showed us how the pursuit of quick profits can lead to long-term pain. The housing bubble, a real estate catastrophe that shook the world. A financial disaster that serves as a warning sign, a cautionary tale of what can happen when greed trumps prudence. Finally, we come to the most recent, the Bitcoin bubble. Born from the digital revolution, Bitcoin and its fellow cryptocurrencies sprang into existence, promising a decentralized alternative to traditional finance. This new form of digital currency, shrouded in complex algorithms and cryptography, captured imaginations worldwide. Investors, driven by the allure of unprecedented returns, dove headfirst into the unknown waters of cryptocurrency. The value of Bitcoin soared, reaching dizzying heights, yet like any market subject to the whims of speculation, it was not immune to volatility. In the blink of an eye, fortunes were made and lost as Bitcoin's value oscillated wildly. Critics and proponents alike have engaged in heated debates about Bitcoin's true nature. Is it a bubble destined to burst and leave a trail of financial ruin, or is it the future of finance, a new frontier in the digital age? After all, bubbles are traditionally characterized by a sharp increase in asset prices, followed by a sudden crash. Yet Bitcoin, despite its volatility, has shown a resilience that challenges this narrative. The Bitcoin story is still being written. Its future remains uncertain, its potential untapped, and its risks unclear. But one thing is certain, it has forever changed the way we look at money. The Bitcoin bubble, a speculative saga still unfolding. We hope you enjoyed this dramatic journey through history, tracing the rise and fall of various market bubbles. If you found this video informative and interesting, please hit that like button. It helps us create more content just like this. And don't forget to hit the subscribe button and the bell icon to stay updated on our latest videos. We at Financial Fury are committed to bringing you the most fascinating facts from the world of finance. Stay tuned for more Financial Fury facts. Until then, keep investing wisely and remember, knowledge is the best investment. Thanks again for joining us in uncovering the mysteries of market bubbles. Your support helps us delve deeper into the world of finance to bring you the most captivating stories. If you haven't already, do hit the subscribe button and join our community. Your likes not only motivate us, but also help us create more educational and fascinating content. So don't forget to press that thumbs up button if you enjoyed our video. Stay tuned for more riveting facts and figures from the financial universe. And always remember, your best investment is knowledge. See you in the next video.